Are you ready to take control of your wealth and design the life you envision for yourself and your family? Welcome to Wealth of Insight with Austyn Whittenburg from Whittenburg Wealth Partners. Austyn guides you through the entire planning process to help you build a plan that seeks to protect your financial future. He empowers you with creative investment opportunities and planning ideas to help you understand and achieve your long-term goals. It's time to gain confidence in your financial future. Now, on to the show.
Welcome back to the Wealth of Insight podcast. Today, we've got Jeff Gross with Apollo Global Management joining us today. Jeff's worked with my dad, I don't know, probably going on 20 years or so, wouldn't you say, Jeff?
Yeah, it's been early 2000s we started working together.
And I might have met you on my very first day, so we've worked with Jeff for a long time here, and he's helped us provide real estate solutions to clients. So today I thought I'd bring him on to talk real estate. It's one of the most common questions I get. So, I know it's something that's on everybody's mind. Jeff, why don't you give us just a quick 30-second, 60-second history on how you started in financial services and got to where you are today?
Sure. Thank you, Austyn. So yeah, my career started back in Boston with a mutual fund company. It was Pioneer Investments, and I know they've gone through some name changes and what have you, but I was an internal wholesaler there. And then they promoted me to be an external, where you go out into the field and live in your territory. So I moved to Denver in 2002, and I stayed there in Denver till 2005, just doing mutual funds. And
just stocks, bonds, that, normal kind of mutual fund stuff. Okay.
Exactly. And then in 2005, I was recruited by this small private real estate company down in Phoenix called Cole Capital. At the time, they had about $800 million under management. They were putting together a distribution group, and they wanted to raise money in what's called the non-traded real estate investment trust space, where you raise capital, you go out, and after you raise the money, that gets deployed into buying individual properties. Those properties generate cash flow, and you own a portfolio of what could be $1 billion or $2 billion after you aggregate it and raise money for a few years. And so I was with them for 10 years, and then we went public and got sold, joined Griffin Capital in 2015, was another private real estate shop, did the non-traded REITs, but then the industry changed a lot when FINRA came along and adjusted the rules. So the interval fund structure, which is now very popular, is something where rather than you're just putting money into a private investment and depending on the home office to deploy all that capital and could be very sector specific. Now, the interval fund structure is a ticker symbol. It prices every day. You get a very diverse portfolio, and they're perpetual. So you don't have a finite life cycle. This is something you can buy into it today, and you may want to hold it for a quarter. You may want to hold it for 10 years. It's completely up to you and your clients. So that's the structure there. And just recently, so when you introduced, I'm working with Apollo now, it's because Griffin, we announced in December that we were going to be acquired by Apollo, and that transaction took place March 1st. So now I work for Apollo Global Management only through a acquisition.
All right. You've worked several places. Yeah, several places, but real estate sort of has weaved its way through all of that,
Yes.
And as I mentioned, it's one of the most common questions I think I get is, should I be buying real estate, investing in real estate? Everybody hears about it. I think they like it because you can drive up to, let's say, a rental home and touch it and look at it, and it's tangible. Whereas when you walk past the Apple store, you don't maybe get the same feeling about the Apple stock that you own. But, and typically when clients are asking me that, it is sort of that residential real estate focused. Hey, should I buy a rental property, own it, and collect the cash flow? So what I wanted to talk about today is this other side of that investment world. You mentioned a couple things in there, non-traded REITs, which are, as you mentioned, real estate products, the interval funds, but publicly traded real estate, something I want to just take a few seconds on too, because you can also just go to this, stock market and buy a publicly traded real estate company. But there you may not get some of the same types of diversification we would like. If you're owning the stock in the stock market, that real estate fluctuates pretty similar to just traditional stocks. We're not going to spend too much time there. I want to spend most of our time sort of on the private real estate space. So let's get into it here. Why should a client, consider real estate as part of their overall portfolio?
Sure. So the first thing is, Austyn, that you mentioned public. So I want to spend a minute there. Public real estate in real quickly is you buy, type in a ticker symbol, and that ticker symbol XYZ, which is not a real traded REIT, but you just type in your ticker symbol like you would to buy Microsoft or Google or Amazon, and you buy shares of a publicly traded company that happens to own real estate. Well, you don't actually own hard assets. You just own shares of this company, and it's going to price based on supply and demand, and you're going to get an 80% correlation roughly to the stock market, because it's going to price, like I said, earnings and supply and demand and cash flow and things like that. It doesn't really trade. Like if you own a hard asset, like you were mentioning, if you own real estate directly, that price is based off of who the tenants are, what's the lease duration, what's the quality, what's the cash flow, location. There's 50 different metrics that go into the pricing, let's say, of a piece of real estate, and the different sectors. That major categories are office, industrial, multifamily, and retail. Those are all commercial real estate. And then you can get specific into like healthcare and storage, self-storage. Then you can get data centers and things. But still, the four major categories are all considered commercial real estate. And so owning the private side, there are a lot of benefits to that.
Well, so let's get into some of the benefits then there, because the last few years I think has been a little bit, well, even just this year. Here we are, middle of June 2022. The stock market's really sold off. Real estate has almost done the opposite. So let's talk about. You have any info or data on, hey, what does this look like if I'm a traditional investor? Say I own a portfolio of 60% stocks, 40% bonds. How much real estate should I add? What are the benefits to me by adding in this new asset class?
Sure. So when you look at traditional 60-40, you're going to see returns typically, if you look from 2000 to 2020, you're going to look at an average of about 7 to 8%, right? With a volatility, which typically is measured by a standard deviation. And you're going to be in the high nines, high single digit, low double digit volatility.
But the average person doesn't have the capital or, the time for that matter to worry about having proper diversification in the real estate space. Because if you're, most people that we keep bringing it up, mentioning rental properties, you're pretty geographically locked in. There's a lot of risks that maybe don't get considered there when people are looking there. If we want true diversification, it takes quite a bit of capital in the real estate world and or significant debt to make that happen. If you're just going out there on your own, trying to make sure you have good exposure to these different industries and sectors. And it's been really interesting. You mentioned the public real estate side of things. That's such an interesting dichotomy to me, where publicly traded real estate, as you said, is off, but most people's homes, they've seen their homes appreciate, or these other things have continued to appreciate. And that's really, I think, the power of having some of these more private type options, almost mimicking what the ultra wealthy and the big institutions can do, but at a lot more consumer friendly price point, so to speak.
That's absolutely. Yeah. There's the structure is an interval fund, and the interval fund is one that you can invest in, and through the aggregation, right? So this is a perpetual type of vehicle, and in an interval fund, you're raising hundreds of millions of dollars, and even up to billions of dollars. And as you do that, you then can go out and invest alongside of institutions in these private equity funds. So there's anywhere up to 40 different funds that pension funds and insurance companies and endowments can invest in, and they are open-ended and they're diversified. And what you're going to look for is a fund that will give you exposure to like the sectors that I was just mentioning. So
Right.
to your point, very difficult for an individual to go out and get this type of diversification because they may not have the capital, like you said, to buy all the different properties. But not only do you have to acquire them, you then have to manage them. You have to deal with tenant turnover. You have to deal with vacancies. These are all things where you look to companies that are built for this and handle all of that for you. And then you really are investing in the fund to generate cash flow. It's an income play because all the tenants are paying rent. And then after you're looking for some appreciation, right? You own buildings that have tenants in them. They occupy them. They're paying rent. You're increasing rents, hopefully over time, and then looking for some appreciation on the back end. And in inflationary times, you also do have a component of the fact that you have a hard asset, right? So this building is made up of bricks and glass and steel and concrete and all of these things, which we've seen are increasing in price.
Right.
So you have a cost of replacement component as well.
Yeah. And we've seen that, the last couple of years, real estate prices, everybody knows, have really gone crazy, really skyrocketed. Historically speaking, as we stretch this out over 5, 10, 15, 20, 30, 50 years, right? Really, a lot of the return, would you say, comes more from that income side of things?
Yeah, I would say that when you're looking to invest in this type of real estate, this is more core, and it is not a major growth component. And when I say this type, when you're looking at conservative interval fund type investments with the ticker symbol, that we're buying assets that are fully leased up. We're buying assets that we're thinking time horizon anywhere from 30 to 50 years of a type of hold. This is not a fix and flip strategy. You're not buying something that's 40 or 50% occupied, going in, fixing it up, and then looking to flip it in a short amount of time for some big growth component. You can get that type of exposure just in different aspects of investing. That's going to be more aggressive. That's typically going to be in a private placement structure. Whereas here, this is a public version, meaning you look at it with a ticker symbol, and from a suitability perspective, it's much different than going after those private type investments where you might only have one or two properties that you're getting into. This gives you exposure to private real estate, but in a fund structure.
Yeah. And that's, from our standpoint and a lot of our clients, I think they appreciate that sort of hands-off / less brain damage approach to real estate, right? How can we benefit from the asset class? How can we have exposure to multifamily, to, industrial warehouses, the Amazon revolution of the world? Or how can we get exposure to these things? But I don't have to be the one on the phone with the tenants, that sort of hands-off approach. So we've hit on the income piece. We've hit on, I guess, I'll use the industry lingo, the non-correlation piece, right? That's the, not necessarily moving the same way as the market does. We can have some assets moving differently than the S&P or than the stock market in general. So those are two of the big components. Let's touch real quick. I want to just touch real quick on maybe some of the tax benefits from that income. And then we, to be fair, maybe touch on a few of the trade-offs in the interval fund structure as well, but just with real estate in general. So, all right. So we've got this portfolio of real estate. They're kicking out their distributions. What does the tax treatment look like on the income that's being generated?
So you're going to generate cash flow. It's going to be paid out typically to the investors on a monthly or a quarterly basis. And then the benefit of owning a hard asset like real estate is depreciation, right? And so you're going to get a 1099 at the end of the year. You're going to be able to take advantage of that depreciation. And depending on your fund, it could be anywhere from 50 to 75% tax advantaged. So you get your cash flow, But at the end of the year, when you're doing your taxes, you take a look at your 1099 and say, okay, well, maybe I got a 5 or 6% type of income stream. I'm only paying tax on 25 to 50% of this. So now you've got a nice tax advantaged distribution. And the depreciation is the reason for that. So that depreciation is lowering the investor's cost basis. So they do want to keep in mind that if they hold this for a particular amount of time, whether it's 3, 5, 10 years, and if they decide to sell it, there will be some recapture, and that recapture will be taxed as long-term capital gains, though not as ordinary income. The other benefit, though, is, let's say for your clients who want nice, predictable income, they just say, hey, this is an interest rate environment where it's tough to really find much income. I mean, we all know the bond story. We don't need to get into that as rates go up. It's a place that people have reduced exposure to. But if you have some income stream here along the way, if and when the client passes away, the beneficiaries get a step up in basis, and therefore there's no recapture. So that's an advantage, especially for some older clients looking to invest in real estate.
Yeah. And well, for the past decade or so, bonds maybe are catching up a little bit to the real estate side of things. But in terms of looking for income, especially for those older clients, this has really been a great place to get it because interest rates had been so low for so long. So,
absolutely.
Okay. I did want to touch just to be fair on the trade-offs here for some of these things, because there are, some restrictions to liquidity and other things typically with real estate. So, obviously if you go out and buy your own building, it's not very liquid. You're going to have to hire a realtor to sell it. In some of the investment products that we have, it's more liquid than that, but there still are certain time periods. So just want to make sure, when we're working with clients and looking at their entire picture as part of their financial plan, we make sure we keep that in the back of our minds, knowing that, hey, this is money. If we're going to make this decision, this is really money we want to be in there long term. With the typical interval fund structure, you do have quarterly liquidity, and each fund is required to have a certain amount of cash each quarter available to redeem. But we're really looking at it for our clients like, hey, once we're in here, this is something, I think you've used the word a few times, perpetual. This is something that can be in the portfolio for a long time. If you don't need the income, we still get that favorable tax treatment, reinvest those dividends, or look for something, use that cash flow somewhere else, or as part of a retirement income stream, this can be a great fit. So I want to touch on a few things here real quick, and we've briefly mentioned them, but I want to drill down a little bit more specifically. The first is rising interest rate environment. Rates have been increasing each year, or not each year, each month, each day here over the last 6 months. How does that affect the commercial side of things? Maybe it's the same. I don't even know. Maybe it's the same. Maybe it's a little different than how it's affecting the residential real estate market.
Yeah. So interest rates going up, think of it as if you're originating your debt, if you're going out and buying all of your properties right now, then it's going to have an impact on your cash flow because you're utilizing mortgages, let's say, at a higher interest rate. Well, if you have a portfolio that exists that's multiple billions of dollars, and that financing has already been put in place, it's locked, it's typically 10 to 15, maybe even 30 years, and you don't use a lot of leverage. So if you use maybe 25 or 30% leverage rather than going 70 or 80%, then you really put up some walls around you for the chance of failure gets much less, because the people that get themselves into trouble are the ones that over leverage with short-term financing. And you get into a situation like we have right now with rates going up. Let's say you locked in a nice 3 or 5 year loan back in 2016, 2017, and that resets now. Well, if you were in the 3s and now it resets in the 6s, and you had too much debt, then that's where you find yourself in trouble. So it's really the type of leverage that you use, and not necessarily a bad thing to use debt, and just use it conservatively. And if you've got, like I said, tenants in there on long-term leases with predictable cash flow, you'll be able to weather pretty much any storm. And that way you're not sitting there trying to refinance in an environment like we have now. Now, if you're buying new properties, which we're always going to be looking to add to the portfolio, you just want to go in and we will look at managers who buy cash only, and then they put the financing on later if needed.
Right.
So like in a portfolio that we have right now, I can tell you as an example, our average manager is only using 30% financing. And they don't use that financing to purchase the property. They put the debt on, like I said, after the property's purchased.
Okay. All right. You mentioned weathering the storm there. So let's the final point here. Let's talk about recessions, right? That's in the news a lot these days. It's almost, I would say it's inevitable that we have a recession, just who knows when that's going to be, right? We know that that's sort of the way that the economic and business cycles go. So how does this commercial real estate we've been talking about, how does it fare during recessionary periods? How does it fit during times of the sort of stock market volatility we've had recently?
Sure. Yeah. So let's use an example like when COVID hit. We'll go to like March of 2020, and the market was down 30+%. Publicly traded REITs were down roughly the same amount, whereas private real estate, right? We're looking for diversification. We're looking for non-correlating assets. The tenants were there. The buildings were occupied. The leases were in place. And the easiest way to talk about this is a lot of people will say, well, boy, people were working from home. What about those office leases? The beauty of being a landlord is the tenant's still paying rent. You're not tied to whether they just happen to be going into work or not. If there's 5 years left on that lease, 10 years left on that lease, the tenant continues to pay rent, even though they may not be going in. And there are negotiations that can be made. There's rent relief and things like that can happen. But for the most part, you're still collecting rent. You're still cash flowing. The value of those properties did not go down 30% because COVID hit. Right. And then you look at other sectors that benefited from that. Definitely industrial, multifamily, more people working from home. You look at portfolios that are nimble and can move based on what's going on around you. And that really is one of the benefits of an interval fund structure, is the ability to buy and sell the shares of your private equity managers based on which sectors you may want to be increasing exposure to or decreasing exposure to.
Yeah, that kind of flexibility we really like. And, that speaks to just having diversification as well, right? That's sort of just the time and tested true statement is diversification is, something we definitely value. So, well, Jeff, I appreciate you coming on today. I think this was really helpful to give people a view on what the real estate world looks like and how it may fit in their portfolios. So if you have any questions or you'd like to learn more, feel free to check out our website at wittenbergwealth.com, or you can text me 801-839-7056. And please remember to subscribe to the Wealth of Insight podcast and share with your friends and family.
Thank you for listening to the Wealth of Insight podcast. Click the subscribe button below to be notified when new episodes become available. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Tradeoffs Wealth Partners, a registered investment advisor. Tradeoffs Wealth Partners and Whittenburg Wealth Partners are separate entities from LPL Financial. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Whittenburg Wealth Partners. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.